When candidates fail the universal life section of the producer exam, their scores usually collapse over a single misunderstood phrase: flexible premiums. Universal life is a form of permanent life insurance. As long as the policy stays in force, it provides lifelong protection to the insured. Unlike term insurance, which offers purely temporary death protection, universal life builds cash value. Over time, part of the money flowing into the policy pools into an internal financial reservoir. Here is where the exam sets its trap. Candidates see the term flexible premium and assume the insurance is free, or that missed payments are simply forgiven by the insurer. Flexible does not mean the policy can survive indefinitely with zero external funding. Misinterpreting the strict mechanical limits of this flexibility costs candidates easy points. To pass, you have to look under the hood and understand exactly how this policy's underlying engine actually works. To understand flexibility, we first need to look at its opposite, whole life insurance. Whole life is built on a highly rigid, unchangeable foundation. This block represents a whole life policy. It operates under 3 fixed constraints: a fixed premium, a fixed payment schedule, and a fixed death benefit structure. Universal life removes those padlocks. It replaces the fixed constraints with a system that allows policy owners to adjust their premium payments. In many cases, the death benefit itself can also be adjusted up or down. As these inputs shift, the internal volume, the cash value, expands and contracts in response. This shift transfers the burden of responsibility. In a rigid policy, the insurance company guarantees the structure. In an adjustable policy, the owner assumes the risk of keeping the structure intact. Flexibility is a mechanical trade-off. To survive turbulent funding or skipped external payments, the policy must rely entirely on its own internal cash value. Because of this structure, a universal life policy owner has specific rights. They can pay more than the planned premium, they can pay less, and occasionally they can skip a payment entirely. But a skipped premium is only allowed if the internal cash value is large enough to support the policy on its own. Every single month, regardless of whether the owner writes a check, 2 specific internal charges must be paid: the pure cost of insurance and administrative expenses. Take a look at this digital ledger. Right now, there is exactly $3,000 sitting in the cash value reservoir. This policy has monthly deductions of an $85 charge for the cost of insurance and a $15 fee for administrative expenses. That brings the total monthly charge required to keep this policy active to exactly $100. If the owner skips a month and pays zero out of pocket, the insurer siphons that $100 directly out of the $3,000 cash value. The policy legally remains in force for that month, strictly because the cash value was sufficient to cover the internal cost. This internal cannibalization is the defining trait of universal life. Skipping a premium means the policy is paying for itself, until the internal funds run dry. If the owner repeatedly skips premiums without ever replenishing the pool, the math turns dangerous. As the cash value cushion steadily shrinks, the policy loses the very flexibility that defines it. To save a drained policy from failing, the owner will eventually be forced to resume making significantly higher out-of-pocket premium payments. If the cash value reaches zero and the monthly deductions cannot be paid, the policy lapses. All protection ceases immediately. A common exam trap claims that a policy can never lapse if it has built cash value. That is false. Cash value is temporary if it is constantly being drained to cover internal costs. The flexibility that makes universal life attractive is also its greatest vulnerability when an owner fails to monitor the internal costs. That brings us to the second major exam trap: the strict rules governing how the death benefit is paid out to beneficiaries. Many students assume that upon the insured's death, beneficiaries automatically receive both the policy's face amount and the accumulated cash value. In most cases, they do not. Universal life generally offers 2 choices. The first is option A, defined strictly for the exam as the level death benefit option. This vertical bar chart illustrates option A. With a $100,000 face amount and $20,000 in cash value, the beneficiary receives exactly $100,000. The logic is simple. Growing cash value reduces the insurer's pure risk. The ceiling stays flat at $100,000. The best memory trick for the exam is this. Option A is for alone. The beneficiary receives just the face amount, alone. By contrast, we have option B, defined strictly as the increasing death benefit option. This second chart shows option B. With the same $100,000 face amount and $20,000 cash value, the math changes. The beneficiary receives $120,000. By stacking cash value on top, the insurer's net risk remains higher, generally costing the owner more. The memory trick here? Option B is for bonus. The payout is the face amount plus the bonus of the cash value. The choice between option A and B dictates exactly who captures the financial benefit of the cash value growth, the insurance company or the beneficiary. Success on the producer exam requires you to abandon real-world assumptions and stick purely to these mechanical rules. Universal life is permanent protection, powered by a flexible premium and an internal cash value engine. Skipped premiums are only permitted if the accumulated cash value fully covers the internal monthly deductions. If the policy is underfunded and the cash value drains to zero, the policy dies. Option A is a level death benefit, where the beneficiary receives only the face amount. Option B is an increasing death benefit, where the beneficiary receives the face amount plus the accumulated cash value. Universal life gives the policy owner immense control over their financial destiny, but it demands absolute responsibility to keep the engine running. That balance is exactly why it is the ultimate test of a producer's knowledge.